Happy Wednesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, January 24th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So we'll start with today's key macro event, which is green shoots in the global economy signal upside risk for risk assets over the medium term. The nuance there is the preliminary January PMI data from the major economies signal green shoots in the global economy, which represent upside risk for risk assets in the medium term. Elsewhere, the PBOC will cut the reserve requirement ratio for major banks by 50 basis points in early February. The move will add 1 trillion yuan or 139 billion US dollars in liquidity to the Chinese financial sector. We expect the move to have a greater positive impact on global liquidity than the Chinese economy because of the structural liquidity trap we re-identified in early 2023 when we told investors to liquidate their China and related holdings. In terms of market implications, it is our view from speaking with institutional investors that investor consensus is not paying adequate attention to these green shoots in the global economy. The winning hand of 2023 was the resilient U.S. economy theme that we authored in the summer of 2022. The winning hand of 2024 may be the green shoots globally theme we introduced in earlier this month. Refer to our January 3rd leadoff morning note for more details. Transitioning to our 42 macro dashboard here, we're going through the trading range from our friends over at Longbow, getting an overbought condition in base metals there. So be aware of that if you're long that particular exposure, but that makes sense in the context of green shoots globally. And I think we're getting a near oversold condition in Ethereum still. So be aware of that. Ethereum still hodling at the lower boundary of its trading range there. Bitcoin has bounced a little bit off the lower boundary, kind of in the middle of the range now. So be aware of that. Looking like some stabilization has come into the crypto market, kind of right around the level that we identified when we called for the correction a couple of weeks ago. We said 38,000 was that Fibonacci retracement level. So seems like we went right down there, kissed it. We'll see if it rallies from there. Transitioning to our 42 macro community, getting a question from one of our clients about the top-down versus bottom-up grid regime. So for those of you who are not clients, top-down, bottom-up grid regime is what regime is the market's pricing in. The bottom-up grid regime is what regime the economy is in. Generally speaking, they match. And when the times when they do not match, it's usually a function of the market's leading a phase transition in the bottom-up grid regime in terms of what the economy is doing from a growth and inflation perspective. So I'll read the question. I want to get your perspective on how to manage separately managed accounts when the top-down and bottom-up macro signals conflict with each other. Here I specifically refer to the regime generated on the basis of incoming economic data and the top-down regime implied by the market itself. It seems we 42 Macro, are shifting more towards the market's implied regime and putting less and less weight on the bottom-up macro forecast. From your point of view, do you see any value in the bottom-up macro regime at this point in time? Or will we be more rewarded for following the top-down market's implied signals and liquidity dynamics? So the short answer to that question is you're always going to be more rewarded for following what the market is telling you to do. In terms of our process, you certainly over the last, we started the firm 3 years ago. When we started the firm, we were very much in the camp of predicting what the economy is going to do, putting on positions in accordance with that position that predict those projections, and then kind of risk managing from there. As we've migrated over time and through experience and observation, we've noticed that the market regime has diverged more from the bottom-up economic regime for more on a frequency basis, much more than it had been in recent years. And so that's something that we've noticed and really incorporated into our investment process. And two, just generally speaking from a philosophical standpoint, we've also noticed that there's been a significantly higher degree of volatility in economic statistics in this post-COVID regime. Both the higher volatility in nominal growth, higher volatility in real growth, higher volatility in inflation, and obviously higher volatility in policy when you think about the swings we've seen in fiscal and monetary policy, both domestically and globally in this post-COVID regime. And so for a lot of investors, particularly on the bottom up that are focused on creating predictions for their positions, a lot of investors, may not even realize that a lot of the models that, economists like ourselves use, the DSG models, autoaggressive models, those all broke in 2020. And so anyone relying on predictions as the basis of their positions has to accept the fact that they are essentially flying blind and sort of using a much less statistical, much lower, much lower probability statistical methods to predict the future. And so rather than rely on lower probability statistical methods, we have incrementally and importantly profitably pivoted towards anchoring our investment decision making and our factor and portfolio construction recommendations on the evolution of the top-down market regime. Just throwing out a couple statistics at you, or one statistic at you. Over the last 1 year, 3 year, 5 year, 10 year, and 20 years, on average, there's in each of those discrete time periods, on average, there's been about 3 what we call row phase transitions for investors to risk manage. Now, what row phase transition means is it implies risk on to risk off, or risk off to risk on. And so if you only have to do that 3 times a year, you really don't have to worry about too much volatility and turnover in your portfolio by anchoring your investment decision making on what the top-down market regime is, and ultimately trying to identify when that is likely to change and what that's likely to change into. And so that's what our process is really centered on: is what the hell are asset markets trying to price in? What are they going to try to price in next, based on the signals that are being generated by our global macro risk matrix, our macro weather model, and ultimately our fundamental research process, which gives us a clear indication at most times about what the markets are going to price in next. So I think it's a better process. It's certainly a different process. Most investors are out there, again, relying on predictions to put on positions. We obviously formulate predictions, and I think we're among the world's best at formulating predictions about the real economy, about policy, and ultimately asset markets. But those predictions aren't the foundational basis for the recommendations that we are making for investor portfolios. The foundational basis that we are making for investor portfolios, again, is born out of that top-down regime signaling process. And ultimately, we use our other tools in our process, again, the weather model and our fundamental research process, to give us an indication of how long the current regime is going to last. And ultimately, if it's not going to last, what is it likely to change into? So it's just a different way of thinking about it. And ultimately, we've proven that it's a better way of thinking about it. So we're not going to mince words about that, because we're kicking ass and taking names here at 42 Macro. So we'll wrap it up there. Darius Dale presenting our macro minute for Wednesday, January 24th, 2024. Everyone catch me on Real Vision Daily Briefing, back on with our friends over at Real Vision this afternoon at 4 p.m. ET. Everyone have a wonderful day out there. We'll see you later. Cheers.